Bank funding requirements, we'll talk about that. I've got a little bit of information on it after this, but in general, the typical funding guidelines for the development industry have changed dramatically. The old rules that existed for 20 years are no longer and probably aren't likely to return. We expect that for at least a decade, the conservatism in terms of bank lending guidelines will continue. And what that's meaning is it's very difficult for developers to get projects out of the ground. So from a property fundamental perspective, it's a big positive, because if you've got population growth, which we have, and we've got a whole slide on that, but if you've got a high population growth and lower levels of dwelling approvals, and again, even lower levels of those approvals getting built, because the banks aren't lending to the sector, it means that from a supply-demand perspective, you've got high demand with population growth and low supply because approvals aren't coming through with a restrictive planning environment, and also from a banking perspective, less of the projects that could get built are meeting the criteria. So a lot of developers that would otherwise have built in previous cycles won't get that product onto the market. So from a property investor perspective, that's great, because it means likely to get higher rents coming up as that supply-demand situation worsens. And we've got some slides on that a little bit further on. The new sector participants, and this is really how, I'll tie this into how it relates to self-managed super, but post-GFC, we've seen the senior banks reduced their overall property exposure by around $20 to $30 billion. We've seen the typical mezzanine lenders that have been big funders of developments in the past exit the market, and a lot of the foreign banks exit the market. So there's been new players coming in. And those new players are generally hedge funds and opportunity funds, in particular family offices. So these institutional or quasi-institutional and a lot of ultra-high net worth have been lending to property developers at very high rates of return, or have been participating in the development sector. But what it means for the developer is they're making a lot less money. It's these new participants in the sector that are taking a lot of that return out because there's a shortage of capital. So it's great for those new investors and it's no good for the developers. And actually just this week there's been the main residential development forum in Canberra, and it's the common theme. They've all been complaining there's not enough capital, the banks aren't lending to us like they used to. Even when we've sold the whole project, we can't fund it, and we need new sources of capital. So the whole industry is scratching for ways to attract new capital into the sector, but the reality is that new capital that's available is taking a lot of the return of that development for themselves and leaving very little for the property developer. The biggest point to note here really is the loan-to-value ratios. The banks were willing to lend around 75% pre-GFC, which meant the developer didn't need a lot of equity into the project to make it come out of the ground. Nowadays, the banks will be around 50, max 60% against the value of that project when it's built. And they're also requiring a lot more pre-sales. So it means if they've got a residential project, let's say it's worth $10 million, a private developer, and they've got 20 apartments worth $500,000, and the bank's willing to lend half of that, so let's say $5 million, they'll generally expect that about $6 million, which would be 12, maybe even 14 of those apartments have been sold. So whatever they'll lend, say $5 million, they'll expect more than that to be covered with pre-sales, which again is quite restrictive, and meaning that a lot of these projects won't occur or will take longer to occur. In terms of the total development costs, and the metric we've used there is TDC, the banks will only lend around 65%, and it's unlikely they'll lend more than that.